Morning.
Verne is Senior Vice President, Regional Manager with CTX Corporation. Are you out of Texas or on the West Coast?
It's based in, the corporation is based in Dallas, Texas.
Right.
And I'm the Regional Vice President over to California.
Over to California. Okay. Before we get started, everybody, most of our listeners like to know where people came from and kind of how they got into business. I do know that you were a major producer years ago before you became a senior VP. And just thought maybe we do a little background and how you got into business.
You bet. Started in the industry in 1981 as a mortgage broker, and from 1981 to 1985, I was a mortgage broker out in the industry. 1985, I joined Shearson Lehman Mortgage, and I became their top producing branch manager in the country for almost 5 years. My personal productions were about the $60 million a year annual range. And the branch production was about 150 to 200 million. I was up in the Everett, Washington marketplace.
Yeah, that's not in existence anymore. I know they had an office.
Glass was the president back at that time, and they sold the company off to any number of mortgage bankers.
Right.
And it was at the sale of Shearson that I took a trip to Dallas, Texas, and met up with Centex Corporation. Centex Corporation is primarily a home builder, and that's the platform that we build our business off of. And we're also retail originators, spot originators out in the marketplace. I head up about 30 facilities for the company. 30
branch offices, or for retail, or are you talking about builder?
I have 7 builder offices.
Oh, I see.
About 28 branches and satellites throughout California and Houston. It's kind of unique because I've got many of the top producers reporting to me from Mortgage Originator magazine, and it's been a lot of fun working with these folks. Mark Cady, who is the #1 originator in the world and has been for 10 years now, is in Houston, Texas, and he reports directly to me, and we're working on taking him to 3,000 units this year.
That's incredible. Yeah, I know. I'm very aware of the list. Interestingly enough, there are quite a few people who are not on that list that have volumes in excess of 50, even $100 million. But I'm very familiar with his name. And also something else that I think is rather interesting, when you look at the list that they put out, you really dominate the country in terms of top producers.
Yeah, Rodney Anderson, Jim McMahon, Jim Doan reports directly to me.
Yeah, I talked to him a couple of weeks ago.
And Mark Cady. And
we actually have, I don't have my computer on now, but you really have like maybe 13, 14 top producers in that group, and not just at a low level either. They're all serious people. And,
right. Yeah. It's basically the platform in which we operate off of. We've been successful in retaining many of the top originators in the country, and it's really internally how we operate that keeps them around.
Yeah. Well, that obviously begs the next question, and that's the only conclusion one can come to when you see the amount of top producers that are coming out of your company. And even though I caution people, and certainly at your level, I'm not interested in anything that's proprietary to your company, it does beg the question of how you can consistently produce originators who are really kind of cranking these kind of volumes.
Yeah, basically, we've got what's a unique approach to the industry, and we started the procedures early on in the 90s, and because we are a Fortune 500 company, in fact, we hold the most admired corporation in America status with Fortune magazine, and that's very difficult to do as a mortgage banker or even as a bank or a financial institution out there. We set our systems up with a low-cost funding line for our branch managers and originators, and we pass through 100% of the SRP. And because of the volume that we produce, we probably have an extra 15 or 20 basis points on gain on sale out there when we sell the loans, and we have a positive carry on our loans as opposed to a negative carry because of our cost of funds. And we bring 100% of those dollars down to the branch.
I see.
So the originators have a lot of dollars to work with for marketing and assistance and education and whatever's necessary to progress their business.
When you say you're factoring in the SRP, are you selling everything servicing released?
Yes, we are. We sell everything servicing released and take a present value and just cash on cash at the end of each month. So we operate
very basic.
Really, we're the second largest non-bank originator in the country, but in reality, we're probably the nation's largest broker because we sell all of our loans. We close in CTX's name, and we hold them on our funding line at a positive carry, and then we sell them for gain on sale. And we, because of the volume and also because of the amount of new construction we have in our pools, which that book of business performs very well, we get a premium on our sales. And we go in and we write special commitments with Fannie Mae. Still, we'll put up the guarantee fees and write our own commitments. And we have to maintain an aggressive underwriting posture out there because of our home builder. Our margins on some of our homes are anywhere from $50,000 to $200,000 when we sell a home, and we don't want a mortgage that's only maybe worth $5,000 to $8,000 get in the way of a home sale. So we'll take a higher rate of risk than will a normal mortgage banker, because the cost of a buyback may only be $5,000 or $10,000. But obviously, we measure risk differently than other mortgage bankers, which has been an advantage over the last decade to the top producers, and that's kind of one of the key reasons why many of these top producers work here is because we have commitments with Fannie Mae that no one else has. And to this day, we've got a no-income qualifier at 75% loan-to-value. So FICO score 710 or above.
Asset verification or just no income?
Just FICO-driven.
Oh, FICO-driven.
FICO-driven 710 or above, and we'll just close the loan. And to my knowledge, we're the only lender in the market to have that particular product with Fannie Mae. And there again, it's a asset to our home builder to move houses, but the spot side gets the advantage of that particular commitment, which is huge. So many times we'll do recourse commitments with our investors. And,
I see. Versus a lot of people.
Another 10 or 15 or 20 basis points. So it's in the way that we measure risk. We also look at a loan as cash on cash. We're just cash flowing loans. We're really just a revenue-based lender. And we're bundling the services with title, escrow, insurance. We're title underwriters. We're insurers. And that contributes about another $700 or $800 per loan. And on our builder side, we're upwards of $2,000 to $2,200 in contribution per loan, and we add in our bundled services, we're up to about $2,800 in contribution per loan. And what that does is it gives us a great leverage to average the mix of the spot origination. And right now, industry average is really only about $100 to $200 per unit. Well, we can get aggressive out there with our spot side and just average in our builder business and come up with a higher than industry average as a per unit contribution, which is just a unique way of operating in the marketplace.
Yeah, and you can only do that because you work on both sides of the deal, so to speak. If you weren't a builder, you wouldn't be able to do that kind of leverage.
Right.
I also find it interesting that you don't have to do that you can do recourse, because when you can do recourse, and you have the money to eat a couple bad deals, there's, you start getting some real efficiencies.
Exactly. Well, we've empowered our managers in the field to set their own price. which they have the authority to do.
At the retail level? I'm sorry, just to split a hair. Are you talking the builder?
No, I'm talking at the retail level. At
the retail. Mm-hmm.
Our branch managers, because we cash flow loans, it's a very unique concept, but they're allowed to set the price in the branch. We don't set national price. Each branch sets their own price, and we just work off of a bottom line in the market. And many of our branches with the bundled services of title, escrow, and insurance just have more dollars to work with than does the competition out there. And those dollars can be used in the form of bringing down price for deviations or recruiting or signing bonuses for loan officers, marketing in a specific market area. It's a very decentralized environment that we work in, and all authority is given to the branch manager, including underwriting authority. So many of our originators are out and about in the market. They may be branch managers and originators, much like Mark Cady. He has the authority to approve a loan right on the spot or make any kind of changes that are necessary to create customer service. And we were early on with that concept. We started operating that way in about 1990, and it's pretty well grown from there. And as a result, we've been very attractive to many of the top producers in the country.
I would think your employee morale would be extremely high.
Absolutely, yeah. We are so decentralized that the branch manager makes all policy and procedure decisions within his own branch as to how he wants to operate and what he wants to be. So regional manager role is really a role of just administration and helping everybody get better out there.
Mm-hmm. Are you finding that you're attracting top producers from other companies? I would think this at some point would almost reach a critical mass and start to feed on itself.
Yes. We have been successful in bringing in many top producers across the country, no question. And I would say one knows one, or one gets referred, or all of the transition going on in the industry. We're really positioned to take advantage of that over the next year or two. Mm-hmm. Out there. We're maintaining ourselves profitably, while much of the industry right now is in red ink. So we attribute that to the decentralization in each of our 250 branches operating independently with just various tools that are available to them.
Well, it's interesting you said that, because Tom Lamalf owns Wholesale Access, so I'm sure you know. He and David Olson, and Tom is a partner with me, and we were talking about some of these same things that you're bringing up, and Tom feels, and he's kind of the guru of these statistics in the country, that between January and the end of this year, you will see a contraction from 90,000 loan officers to 67,500, and about a 25% drop-off in origination companies.
Yeah, those statistics mirror the MBA, but and the MBA also came out with some projections.
Yeah, well, they pretty much do a lot of the stuff for them, as you know, the background stuff.
Right, and what's occurred and what has happened just within the last 90 days is we have three of the major players up for sale in the country. Countrywide Funding, PNC Mortgage, North American's trying to find a suitor, and we expect to see a lot of transition over the next 12 to 24 months in the business.
Yeah, why Countrywide? I'm a little surprised by that. Angelo's a pretty shrewd fellow.
I can tell you that it's very difficult today to not have a parent, either an insurance company or a bank, because of the cost of funds. As you've mm-hmm. seen, we've had some inverted yield curves in the last environment, and short-term money has gotten relatively expensive. Well, the funding lines that mortgage companies are using and the margin squeeze that's occurred, we've actually have to take SRP now and put it into price to be competitive out there in the marketplace.
What you do is your business model, though. Others don't do that necessarily.
That's correct. We're diversified in that particular model, but most companies will just do that nationally. We'll set those prices nationally, and both on their wholesale side and on their retail side, they're really just eating into their SRP. But I suspect that Countrywide is looking for a suitor with an insurance company or a bank where they can get their cost of funds down to 3 or 4%.
Right, which would be possible.
Yes,
and certainly
companies now. I believe over the next 5 years we're going to start to see under the Glass-Steagall reform. We're going to start to see insurance companies get back into the mortgage business.
Right, which they're allowed to under the laws now.
Right.
What do you think this augurs, though? You've posed some interesting questions here, because what do you think this augurs for the mortgage banker industry as a whole? Do you think there'll be a fund? I mean, they're already losing market share like crazy the last 5 or 6 years, to a point where brokers now are, according to Tom, are doing somewhere between 75 and 80%. Pick your number. But what do you think is going to happen now, especially those that want to retain the servicing?
Yeah, it's going to be a lot of consolidation, and it's literally going to be the institution that wants to invest heavily in servicing portfolios. But what we're going to see probably at the end of the line is just 5 major players across the country that are what we call mega servicers. And they'll have efficiency of scale.
Sure, they will.
And they'll also have cost of funds. And it's going to change dramatically. There was a press release Tuesday, July 25th, through Reuters, where the first paperless mortgage in the United States was completed less than a month after the federal law on electronic signatures was enacted. A group of mortgage companies announced on Tuesday. Significant savings in administrative costs were achieved through the processing of electronic mortgages completed in our Florida pilot project last year. It took to bring the loan secondary market was reduced from an average of 45 days to less than 5 hours, said Joe Bryant.
Oh, I know
what
Joe.
You've got now.
Joe Bryant. Joe used to be my boss many years ago as a regional at Travelers.
Really?
Mm-hmm.
He's the general manager for the real estate division it's called eoriginal.com.
Right, they're out of Baltimore.
Right, and it's a process online document service that does the paperless digital loan. Irwin Mortgage Company and Fannie Mae set into the beta site on this, and literally now that this exists, it's going to change the way mortgage originators do business. It's going to transform and take a lot of the people out of the industry. I think the fallout is going to be considerable over time, because it really just puts the originator in place with a servicer on an electronic basis.
Tangential to that, and Scott Cooley at Contour is one of my partners. He's written about this extensively. As far as the internet, I kind of like to get some of your views on the internet. I have my own. The basic hypothesis being that they're probably never going to capture more than 10 to 15%, and the fact that their back end cost, there are not a lot of efficiencies in that back end, and so they're. At some point, they're not going to be able, and the cost of obtaining eyeballs is going up too. But I'm kind of curious on your views with the internet.
Well, if in fact the paperless electronic mortgage exists, which it does today, it's been tested with Fannie and Irwin Mortgage out there, we're going to see changes in the delivery, and everybody's going to be on kind of a fair playing field, whether you're a .com company or whether you're a mortgage banker or whether you're a bank or whether you're a broker. It's going to kind of all meld into one, because it's going to be laptop driven.
Mm-hmm.
And I do believe that as a company strategy, you do have to have some sort of internet strategy out there in some sort or form as a way to do business. But the very best platform today is going to be point of purchase, and it'll be those people with relationships. Now,
right.
Relationships pretty historically were done by referral from realtors and builders and people like that. Well, now the loan officer has to go consumer direct and position himself with the most people in a buying mode in a day. And we've been doing some beta test sites on taking point of purchase through some of our neighborhoods, and we're having excellent results because literally the people are in a buying mode that are going through some of the neighborhoods, and whether or not they buy a Centex home or not, it's a question of just relational selling and adding value at point of purchase with an approval and bundling of the services and creating a customer for life.
Well, in the sense that you're talking about, if you can, and I can remember Angelo, I think I even talked to him about it once, because he was on to that years ago, as you know, going to that person direct, bypassing everybody. And I find that an interesting concept because if you can do that and you can give somebody through, LP or whatever, a pre-approval before they even walk to the realtor's office, the realtor's out of the equation.
It's actually better than a pre-approval. It's an approval today. It's just
well, that's what I meant.
Period of time. I mean, laser titles are coming, and laser appraisals are coming. Our new commitments that we're doing with Fannie Mae are not even going to require an appraisal with our new construction out there. So the mortgage file is just getting thinner and thinner and thinner.
I can see that on a new homes, doing that on the appraisal, pulling out of databases. But do you think the appraisal process and getting an accurate appraisal, that's going to be kind of the last bastion of going paperless? And I'm not talking about urban areas where you have good databases, but in suburban areas and rural areas.
Yeah.
Now, how are you going to do that?
Yeah, it will eventually be digital. There's no doubt in my mind. But that will be the last piece. But it's now on the road. I mean, this is the first time that Fannie is allowing no appraisals out there with some of their commitments.
Do you still need a drive-by?
No.
To see it standing?
No documentation needed whatsoever.
I see. Mm-hmm.
And so we're going to see changes in that arena. There's no doubt. There's many companies working on national data banks for appraisal as we speak out there. And in reality, if in fact you've got data that's within 5 to 10% correct, what difference does it really make if Wall Street is buying a 125 mortgage?
Sure.
We just measure risk and measure the insurer, and away we go. So there's definitely some changes coming.
Yeah, it's all at that point. You're really just talking statistics. At that point, you're right. If you're within a 5 to 7 or 10% range, and you're looking at 100,000 mortgages, who cares at that point?
Exactly.
Probably no different than
the earnest money stand as value. Well, pretty much in the past it has. And if it's just cross-referenced with some sort of national data bank system, and it's interesting to note that the first U.S. paperless electronic mortgage deal was done with a electronic appraisal. So it's definitely a way for the future.
You've actually, as you've been going on, raised another issue too that has come up. It's not like I'm original in this thought, but what do you see as the future for loan officers in general? And I'm talking, guys on the street, loan officers, and also with respect to their commissions.
Yeah,
or do you want to go on record?
No, I'm fine with that.
I think I know where it's headed.
Barry Habib,
mm-hmm.
who is on CNN, I think Barry is at cutting edge in regards to what a loan officer has to be. Going forward, we're going to have to be and wear more hats than we've worn in the past. We're going to need to have our securities licenses, our insurance licenses, probably our real estate licenses, and we're going to have to add value to the consumer at point of purchase.
Well, how does a loan officer, quite frankly, to be a devil's advocate, with what you're talking about, and I agree with everything you're saying, how do they add value worth half a point?
You will see the cost of the loan go down dramatically if we can deliver these loans in 5 hours to the servicer, which is feasible today. There's going to be more margin in the loan, and as you know, each loan has a different value, and literally what the industry is going to start to do is just to back into a profit number, and we're going to start to operate on revenue basing as opposed to basis points or whatever. All of the publicly held companies, of course, are responsible to the shareholders out there, and we've got to show a profit in order to be in business. And with the electronic mortgage, you can literally just back into a profit number because you know what your fixed expenses are going to be, and the rest is commission.
Yeah, actually, you're going to have growth.
And then the whole trick,
you'll have
bundling the services with appraisal, title, escrow, insurance, and trying to create the most revenue per loan. The company that wins this game out there in mortgage lending will be the company that has the lowest cost of funds and is the most technologically advanced company with the least fixed expense in place and bundled services.
Well, when you say bundled services, you're talking about putting the title, putting the whole package together, right?
Absolutely. Yep.
You know, that kind of makes absolute sense out there. But I still have to come back to where the loan officer is going to fit in that model, the way that it's constructed today. You have loan officers that go out there, they make half a point to get overage, whatever, and at some point I see the efficiencies, and I'll say it, I felt this for some time, it's going to drive the loan officer commissions down.
Oh, yeah.
The good ones will, they always survive.
Yeah. Now, well, there's some phenomenons happening out there, and you can look right down to Mark Cady in Houston, Texas. Mark is this is a futuristic model. I mean, he's down there closing 250 to 300 units a month, and he does most of that business with captured business. And what he does is he maintains only about 5 relationships with builders to do that amount of volume. And what you've got there is you have to have a loan officer who is, or a manager, whatever we're going to call them out there, who has a very strong relational selling skills. And they're going to go to sources of business, create relationships, and you're going to have X percentage of the loans go through an electronic system. There's still going to be loans that don't go through the electronic system, whether it be subprime or exception loans or specialty type products or investors across the country that are creating things out there. But I think a loan originator is going to have to get out ahead of the realtor and get out ahead of the consumer, add value, and create captured business in some form or another, whether it be in a real estate office, a builder's office, whether it be consumer direct with debt consolidation. Some way they're going to have to figure out systems. They won't be driven out of the industry. There's no question that there's going to be pressure on the commission side because of the compression of pricing within the marketplace. And as the process becomes more and more efficient, we will be in competition. And there's some very interesting companies starting up. Microsoft's HomeAdvisor.com is positioned to be a very aggressive to the consumer in terms of price and the completion of a mortgage. And so it'll be more and more and more commoditized.
Well, what do you think with respect, you raised an issue that Mark has 5 builders, but I would, once again, being a bit of a devil's advocate here, I would make a point to you that maybe it's not all Mark. He brings something to the table, but in this day and age, you have to bring, as a company, something to that builder, whether it's acquisition, development funds, whatever. I mean, just you cannot have a person walk in and just say, I'm a loan officer from XYZ broker company, and I'm sure going to give you good service. I just don't see where that cuts it with builders anymore.
No, we enter into affiliated business arrangements with these builders.
Exactly.
And we split the profits of a bundled service, the mortgage, appraisal, title, credit, insurance, and drop their acquisition cost. And we're going to see more as the loan process goes electronic and goes digital. We're going to see this as a phenomenon. Well, there again, it's what platform do you bring to the real estate office, or what platform do you bring to the builder, and the splitting of those profits on a 50-50 basis, because the realtors and the brokers and the owners are all living through the same thing that mortgage banking is living through. It's just called compression and competition. They're looking for ways to create more revenue per transaction as well. So if you're bringing more revenue per transaction to the table, and you've got automated systems, and you're a strong relational seller, those are your tools.
Yeah. Are you familiar with Long and Foster Real Estate at all? Now, they're an East Coast, well, not entirely East Coast anymore, but they're, I believe, either the first or second largest independently owned real estate company in the country, and Wes Foster owns it. And the reason I said that, years ago I was their top agent. I'm 57 now, but I was a young kid, and before I got into the mortgage business. But it's amazing to see how they have evolved, where they have created their own mortgage company, Prosperity Mortgage, that has turned, unlike many of the mortgage subs of real estate companies, this one has turned into a real earning machine, and it is well-oiled and does very well. And, you know, they have title companies. I mean, they are putting this all together, too.
Sure. It will literally be an industry in transition in the bundling of services. There's no question about it.
Mm-hmm. It's only through that bundling of services that you're going to bring value added, because that's the only way you're going to be able to cut your cost.
Absolutely.
Well, look, I want to thank you very much for taking your time talking to us today. This has been a wonderful kind of peering into the future, and obviously you have the background and qualifications to talk about it. And I'm sure our listeners out there, presidents of other companies, they're going to take heed and take note to your comments. So thank you very much, and it was wonderful talking to you.
All right. Thank you.